Welcome back to The Dive. A Biden security advisor says a Russian invasion could come any day now. And our guest today will answer what he thinks the impact of this on the U.S. market would be. He'll also touch on the mineral supply to clean energy transition, the global macroeconomy, inflation near term, nickel, and gold. He is the principal analyst and editor of IndependentSpeculator.com and one of our regulars here at The Dive. Lobo Tiggre is joining us today. But before we bring Lobo on, just a friendly reminder to go ahead and smash that subscribe button for me, please. Hey Lobo, welcome back to The Dive.
Hi, Cassandra. Glad to be back with you.
Yeah, thank you so much for joining us again. It's great. Okay, so let's begin here. According to White House National Security Advisor Jake Sullivan, a Russian invasion of Ukraine could be imminent. What impact do you think this would have on the U.S. market, and how do you see the U.S. reacting?
Well, first, I got to say, I'm a skeptic that it'll happen. It's not that I think Mr. Putin is such a nice guy, but there is a mutual dependency there. They sell the gas to the West, and the West, there's a balance there. It seems like a very silly thing to do in a globally fragile economy, but it could happen. I'm not saying it won't. I'm just putting that out there that I'm a skeptic that war is actually that imminent. That said, I'm also critical of the people that just write it off as, oh, that's something for Ukrainians to worry about. That's not our problem. It's a big deal. I mean, if nothing else, the last time in 2014, when Russia seized Crimea, gold jumped about 16, 17% in those weeks leading up to that conflict. So clearly markets do respond. The geopolitical risk of an actual, hot war is something everybody has to worry about. But on top of that, sort of bigger picture to your original question, Russia is a major player in the energy space. It's OPEC plus, and they're the plus. So if something goes wrong, if there's, that can impact the entire global economy in a big way. So I think it's a mistake to write this off as a non-risk, but I also think I would not count this as something that actually will happen. It's dangerous to think the future, but that's what I'm skeptical of.
Mm-hmm. Well, I hope you're right. Okay, so let's move on here. The city of Ottawa recently made headlines when they declared a state of emergency, owing to a shortage of police resources to deal with protesters fighting to succumb to months of lockdowns and restrictions. Do you believe now would be an appropriate time to open up the economy?
It's funny that we frame it that way. I'm not an epidemiologist, and if you're asking me, should we open up the economy, it seems like that should primarily be a medical question that I'm not qualified to answer. That said, it clearly is happening. You've got countries around Europe ending or reducing restrictions. You've even got New Zealand and Australia opening up to travel again. So, why would Canada want to drag its feet? Basically Omicron, whatever you may believe about the medical situation, Omicron looks like the beginning of the end of this whole situation. And whether people are vaccinated or not, Omicron seems to be taking care of that job too. Everybody's going to get it, whatever it is. And, and it's less dangerous. So again, I'm not a doctor. I can't really comment on the medical situation, but it looks like that is ending anyway. So is it a good time? Well, it's happening, Cassandra, whether I think so or not. But do I think so? I think it's way over time. I think it should have happened a long time ago. I personally believe that people should have more autonomy. But now we're in a little bit of a box up there in Ottawa. It's not just the city, it's the national government. Trudeau is, saying all kinds of unfriendly things about the protests. I got to say, though, I'm, again, medical issues aside, I'm pleased to see my Canadian brothers showing a bit of spine up there. And people have had enough. I wish it was on a cleaner cut issue, but people have been so submissive, and the US too, I'm not criticizing Canadians. People have been so submissive all around the world that I got to say the libertarian in me is kind of pleased to see a little gumption showing up there and some spine straightening.
Mm-hmm, definitely. Yeah, I'm in Texas right now, and it's like night and day what's going on in Canada compared to here, that's for sure. All right, so let's move on here. The minerals required by clean energy tech has been a hot topic lately too. To keep global warming at 1.5 degrees Celsius, the world must dramatically increase the production of solar panels, wind turbines, batteries, electric cars, hydrogen electrolyzers, and power lines. Do you believe that mineral supply issues might jeopardize the clean energy transition?
I don't think it's a might, but jeopardize. The minerals are there. It's not the minerals that are the problem. It's the NIMBY attitude, not in my backyard. And the very same people that are pushing this green agenda are also anti-mining. And, something's got to give here. I suspect it actually, incredibly, to those of us who've been in the space for so long, I think it actually might be the anti-mining sentiment that gives, at least for companies that can present a credible, green credentials, ESG credentials, minimize their carbon footprint, or even go carbon neutral. There are some mines that have, mineralization that can sequester CO2. So it's an interesting and complicated theme. I have actually a free article on the website about ESG. I call it potentially the most valuable BS in the world. It's going to make a big difference. Whether you agree with ESG values or not, they're there. And it's clearly a major permitting issue for projects, and that is a big deal for investors in this space. But to answer your question, it's not like we don't have minerals. This is that we keep saying, no, you can't mine there. You can't mine there. No, you can't mine in my backyard. That's the problem. And I do think it gets resolved one way or the other. And I think the one way and the other way is higher prices eventually push this. So the good news is that I think investors in this space will do very well if they have the patience to deal with the ups and downs along the way. And the bad news is it's a bit of a minefield, and this is not something where you can just pick the sector and sit back and, okay, I think selection of the right investments that will make it through the minefield is really going to be important for investors.
Mm-hmm. Okay, so now Russian gas producer Gazprom has entered a supply agreement with China to significantly boost the supply of natural gas. What impact do you expect this to have on the global macroeconomy?
Well, China and Russia have been working together on a number of fronts anyway. So you could look at it as just business as usual. Okay, they're selling more gas to China. China's a big consumer. They need the energy. Of course, they're selling more gas to China. China's still burning a lot of coal, record amounts this last year. And they would much rather burn gas than coal, and also going nuclear. So you could say it's all part of business as usual here. But the timing of the announcement is really quite interesting. We have the sanctions talk. We have the Ukraine situation that we started talking about earlier. This seems pretty clear to me to be a message to the West. Fine, you're going to put sanctions on us. You're not going to buy our gas. We'll just sell it to another customer. The Chinese don't care about the sanctions. They're certainly not going to, they've said there was a joint statement between Putin and Xi just recently. They're backing each other up. Putin's backing Xi up on Taiwan. Xi's backing Putin up on whatever he's doing. Mm-hmm. So Russia's telling the West, go ahead with your sanctions. We've got other customers. Now, that doesn't mean they can instantly turn around all of their supply that goes to Europe and just send it somewhere else. It's not so easy. But the message, I think, is quite clear.
Mm-hmm. Yeah, interesting. Okay, so let's move on here. This week, investors are watching key inflation data, which is the Consumer Price Index, followed by the University of Michigan's Consumer Sentiment Survey. What are your expectations for inflation in the near term?
Yeah, that's the tricky question, the $1 million question, maybe the $1 trillion question with inflation. I don't like making predictions, Cassandra. My sense, however, is that the transitory story, even though Powell retired the word, it's still there. They still think that inflation is going to go away on its own, and so they won't have to raise rates that much. This is a big, big deal. And they don't meet until March. So a lot can happen before they're supposedly baked in the cake rate hikes here. And this data point this week for CPI is one of those critical data points. I don't know what's going to happen. For what it's worth, I do think it goes higher. Some people are saying it could surprise the markets with an 8 handle. I don't know how you could possibly base that. Everybody has all these models and they're all full of guesses. Nobody really knows. But you just look at the price action that's going on, housing, what you see at the supermarket, the gas pump, everything else. there's no reason to think inflation's gone down. So I think we're going to see another high print. And that matters because a lot of the mainstream has been saying, oh, peak inflation, peak inflation. I've seen charts that look like this, right? There was one, Reuters chart looked like this. Oh, we already at peak inflation. And then suddenly there's another higher print. Well, what happens at that peak? It's not a peak anymore. And it opens up to question what happens next. So the one thing I'm certain of is that, there'll be a lot of volatility based on whatever it does or doesn't do. If it does show peak inflation, I think that will surprise people. If it doesn't, I think that will surprise more. For whatever it's worth, my hunch is it goes up. Maybe not as much as some people say because of the way the governments massage these things, owner's equivalent rent instead of actual rent or housing prices. So who knows? But near term, I think it goes up. Longer term, I think we have serious headwinds for the high inflation camp from the base effects, since it was really April last year that the inflation numbers started going up more. Okay. And so that creates a base effect. It's harder to build higher on top of that higher number last year. That's not this month, that's not next month, but after that, that starts to be more of a headwind. And then we'll see, how reality plays in. So to be continued.
Okay, sounds good. So let's move on. Recently, nickel prices have increased due to falling inventories in exchange warehouses. What are your thoughts on nickel?
I'm not sure it's the falling inventories themselves. Correlation is not causation necessarily. Obviously, traders look at that, but it's part of the whole energy picture that we talked about, the green agenda. Rather than get hung up on what's happening right now with LME stocks and so on, I think the more important thing, the bigger picture here, is that one, nickel, it's not exactly rare. It's one of those things that there's a lot of nickel out there, and at the right price, more supply can be brought online. Two big variables here to keep an eye on. One is a lot of the world's nickel comes from Russia. So if there's sanctions, if the Ukraine situation that we started talking about, here's another way that it can play into global markets. It can greatly impact the nickel price. So that's something to watch out for if things heat up there. The other thing is that several Asian countries, Indonesia and Philippines in particular, they kind of went Chinese on the world, and they wanted to just not be the supplier of raw materials. They wanted more value added in their economy. So they started putting restrictions on to force companies to build smelters and so on in their countries. And that impacted nickel prices. This started years ago. And so that bottleneck is loosening up now. Those smelters are being built or have been built, and this is starting to open up again. This is one reason why I've been a little bit less excited about nickel than copper. Both nickel and copper, I think, absolutely essential for the green agenda. Longer term going forward, I'm extremely bullish on both. But in the near term, there's this sort of renewed flow in the nickel space. And I see projections for shortfalls. I see projections for overruns. I just don't think anybody really knows. Certainly, I don't know. And that makes me cautious about just saying, oh yeah, go all in on nickel. But apart from that near term, it's as essential as copper. And, big picture, I'm very bullish going forward, just nervous in the near term.
Okay, great. So before we let you go here, we have to ask you about gold. Gold prices have remained resilient in recent weeks in the face of broad market volatility, decoupling somewhat from its typical price drivers, bond yields, and the dollar. Despite the challenging macro backdrop, do you think investment flows will start to be directed into gold?
I think they are, not starting. They are. That's visibly happening. There's no other explanation. Well, I can't say no other. It seems to me there's no credible other explanation for why on days like right now, when you and I are speaking on Tuesday, gold, the dollar, and rates, all three are up. Like something's not normal there. That's not how these markets normally react. And so what I think we're seeing is the typical trading pattern of these futures traders that say, oh, higher inflation, higher rates, that's bad for gold. That's still there. We see that knee-jerk reaction on a day-to-day basis. But we have also other people that are saying, high inflation is bad. I need to hedge my bets against high inflation. And so you have people buying the dip. I think this is part of why gold has held around 1,800 so much. I think there's been a significant number of investors out there who are like, you know what, I don't know what's going to happen, but I feel a little bit better with a bit of gold in my portfolio. And even mainstream, these talking heads you see on financial media, even guys who are not gold bucks are starting to say that they're getting their clients into a bit of gold. And
Wow.
just to wrap this up, I'll bring my friend Rick Rule into this. He's fond of saying, I know you've talked to him, you've probably heard this from him before. He's fond of saying that the multi-decade mean is for global portfolios to allocate something like 2% of the portfolio. It's just a small 2% to gold as a safe haven, hedge against chaos, volatility, inflation, anything, you name it. But that has dropped to about 0.5% in recent years. So if people were to start getting nervous, like the data you and I are talking about right now, if people are, forget the traders, forget, the COMEX and the futures traders, just investors, people at large are starting to say, you know what? The world looks scary. Inflation looks scary. I think a little gold is a good idea. If that goes back from 0.5% to 2%, that's a fourfold increase in investment demand for gold. Now, I don't know that it has to do that, but even if it goes halfway there, if it goes back to 1%, that doubles the investment demand for gold. That is huge, because it's not like, silver that has industrial and investment demand. Gold is pretty much only investment demand. So this is potentially pretty exciting. This is interesting to see this investment demand coming in and changing the behavior of the prices in the market space, or I like to call it the gold dollar exchange ratio instead of the gold price. I think we're seeing new energy in the space, new buyers in this space that explains the floor that we've seen here. And I think that's extremely bullish. Does it mean it has to go to the moon tomorrow? I don't know. But I'll leave you this one positive thought here on this, Cassandra. In the last Ukraine crisis, when gold increased 16, 17% in a few weeks, really, if that were to happen now from 1800, that puts gold over 2100. So all it takes is a relatively, and that didn't turn into global war. That was a kerfuffle in a limited part of the world. If that happens again, and or investors decide to reallocate to gold as a safe haven, I think we easily see all-time highs again this year. Maybe not just nominal all-time highs, but real all-time highs. That would be something to see.
Awesome. Well, we like to hear that over at the Deep Dive. Well, thank you so much for joining us again today, Lobo. It's been a pleasure talking to you.
Thank you, Cassandra. Always fun.
Thanks so much for watching today. We'll be back again tomorrow, but in the meantime, why don't you check out that video?